and welcome back to another episode of the MRMIA broadcast. I'm your host, Marc Leprince, and you are listening to the Model Risk Managers International Association broadcast. And we're continuing the credit risk scoring series with returning guests Raymond and Pravin, who I'll introduce in a second, where we discuss topics such as shocks, overlays, benchmarking, and today's topic will actually focus on model comparison. So to reintroduce our returning guests, we have Raymond Anderson, who's a published author on credit intelligence and scoring with over 25 years of practical experience. And we're also joined by Pravin Burra, the CEO of Analytix Engine, a boutique AI machine learning modeling consultancy who comes with us with over 20 years of experience in credit modeling, model risk management, and was a previous partner at Deloitte, South Africa. So welcome, everyone.
Thank you.
Thank you, Marc.
All right. So to get us started, Pravin, why don't you introduce us to the concept of model comparison and kind of a little bit overview of why we do it.
Thanks, Marc. Happy to do that. So often when we think about a model, we think that because it's mathematical, there is a unique answer, but life is never that simple. Remember that models are meant to simplify life and to represent life. And because life gives us lots of choices, models often give us lots of choices as well. Often when you are trying to score a population, you will be faced with a number of choices from time to time. Do I include a new data set or don't I? Do I change my old scorecard for a new scorecard? Two team members may build different scorecards. So there's different mathematical techniques for building scorecards. So often you'll have choices as to which version of a model you use or which model altogether to use. So you will have to weigh the benefits of each and as such make a decision as to which model is better and in which context it is better. Often, if we put that into context or make it a bit more practical, you will often be faced with comparing models in two contexts. The first is before you implement a model. You will have the option of choosing different models to put into production, pre-build or post-build, but pre-implementation. Other times you'll already have a model in use and you may be faced with the opportunity of having new models, either because you're testing new data sources or because you've built challenger models, and you'll be faced with the choice of, do I replace my existing model? Do I keep the existing model? Or when faced with 2 or 3 versions of new models, which one do I put into production? So often those types of choices will be presented and will present themselves. And it's actually a very healthy thing. The more choices you have, the more likely you are to get to an optimal solution or a better solution. In terms of looking at how we compare models, particularly scoring models, I'll talk you through some business considerations that you need to consider. And as always, Raymond will take us through some statistical tests that help us weigh up and compare the models. Raymond, maybe you want to start there.
Thanks, Marc. Thanks, Pravin. I must apologize that I did not receive the checked shirt memo, so you're going to have to put up with denim and a t-shirt. So it's a bit chilly outside here. You'll also be watching the sun going down as the light disappears behind me. In any event, my topic is comparing models, and I am going to be looking at the statistical aspect, and I had to bring in a PowerPoint presentation first time in this series because the number of concepts are quite complex and it will aid the audience to try to follow that along. So, screen one share. Now, hopefully now this comes up fine. Okay, I'm getting a thumbs up. So we want to compare models. Now, there are a lot of different metrics that can be used to compare models, and there are a lot of different aspects that we might wish to consider. And unfortunately, in some instances, the the metrics are not bedded down or not commonly accepted. But the main ones, as far as we are concerned, are the power or the ability to put the cases into the correct order. This is for the binary models and credit scoring, at least. The complexity of the model, which relates into the generalizability, whether or not it can be, it also applies to other things other than just the training data set, and the stability over time, whether or not it's going to sort of work in weeks or days or months to come. The other concern overall, it's one thing to have the ranking ability on the case-by-case level or get the probabilities right, but you also want to know, are we getting the right numbers at the portfolio level? Also, does it work across the board for all of the subsegments? Because you will often find interactions and things where the model might work for the young, but not for the old, or vice versa. And the fairness. Is it fair? Are there things that are within the model that are perpetuating human or other biases such that sort of protect what should be protected groups are not getting a fair shake? Now, I've split this into various parts in terms of the comparisons. So these ones here, the power and complexity, those are the primary concerns when you're getting into the model development aspect of it. And most of it relates to the variable selection. If I choose this variable or that variable or the other variable, will it add greater value? But at the same time, you want to try to check for how complex is it becoming. The greater the complexity, the less the generalizability. This applies largely to the generalized linear models, but if you get into the more avant-garde machine learning techniques, neural networks, or random forest, it comes into play with pruning and other things. The pruning and other methods are used to address complexity issues. Then you get into the chi-square. So now these are for goodness of fit measures. Is it fitting the data? And here you have the two aspects. So where you've got the goodness of fit and the generalized ability again. And ideally, as you add in, it doesn't come into the chi-squared measures, but ideally one should take some stuff with a grain of salt if you've got extremely good fit, but sort of is very complex. But one thing about the chi-square is that the focus is hypothesis testing. These methodologies really came up within small data settings. They aren't really appropriate when you get into the big data environments. Chi-square also makes no distinction between the ranking ability and overall accuracy of the model, or at least I don't know how it's done yet. Might figure it out. And then you get into the test matrices, the false positive, the false negative, misclassification matrix, confusion matrix. They go by different names, but this is the stuff where you typically associate it with medical tests. But the one thing about the medical tests and those types of environments is that you don't know what the true population is. You have got no idea. So you're just doing the whole thing based upon those cases that have been presented to you. And every time you hear one of these percentages, it is based upon a cutoff. If you've got a test being applied, there is either a cutoff to some type of a score or a measure, or there is a set of rules where you're saying, did it get it right or did it get it wrong? So it's totally dependent upon what rules are applied, irrespective of what underlies the test itself. And then you get the cumulate separation. Now, or at least that's what I call it. Basically, does it separate the groups that you're looking at? True or false, success or failure, good or bad. There are a number of different measures. In some instances, they are simple. One is a simple conversion of the other. That applies especially to the OROC and the accuracy ratio. The simple formula will allow you to convert one to the other. You also have things like strategy curves that are applied to a through the door population and saying, well, where shall I set the cutoff? What's the reject rate? What's the bad rate? Where do I want to move this to have the cutoff when first applying an application scoring model? You have things like David Hand's H measure, which I haven't figured out how to use yet. I don't doubt that it's a powerful measure. It takes into consideration the relative costs of two groups. I don't know if it fits into the accumulate separation category, but it is something worth considering. And then you get stability, at least in terms of most of the environments that I've worked with. Stability is looking to the population stability index, which would be applied either to the overall prediction or the characteristics or features that are included within the model. Chi-squared can also be used, but tends to be less used. And then the other types of aspects that one wishes to look at. The accuracy of the overall predictions when everything is summed up and you are looking at the portfolio level. Does a particular feature or characteristic dominate the entire model? And do you wish to try to address that, push it to the back of the queue? Are there interactions? Can you measure those interactions and somehow address them? And those interactions may apply at the outset, and you're trying to address them, or alternatively, there are interactions that can change or arise over time. And then the fairness, or the factors over which people have no control. Things like distance from the branch, or the geographical location where they live, that affects the ability of their ability to make payments. Those are often associated with previously disadvantaged groups. Okay, end of the slideshow. Stop share. Everybody else has been very quiet. Pravin, you were supposed to jump in here.
Thanks, Raymond. I think it was just sufficiently interesting for me to be concentrating too much, I think. But thanks for that, Raymond. I think what's important is the first thing you're going to do when faced with the choice of a couple of models is look to the statistical measures. In any of the models that fail a critical statistical measure is less likely to be considered. So let's call it the hygiene level. The models that then pass the statistical measure would be considered for comparison against each other. So given that you have a shortlist, 2 models or 3 models that you want to consider, and you want to compare against each other, they all pass your minimum statistical requirements. How do we then, what else do we consider from a business perspective to help you decide which model to use? The first one is cost of the model. And cost arises from a couple of places. Sometimes when building a scorecard, you might be using third-party data. Think credit bureau data. There's quite a few data aggregators who sell data, etc. You might be buying, for example, valuation of collateral from a third-party professional valuation service. These types of data sets cost money. And so if you're faced with a model that includes third-party acquired data and a model that does not, you'd want to consider, is the cost of the data worthy of the extra lift that is provided by using that data? So often when building a scorecard, for example, you might build it first on internal data, and then include the external data so that you can see the lift of the external data versus the cost of the external data. The second place where cost arises is in the data processing, and cost arises there in two dimensions. One dimension is currency. So what are the actual dollars of the processing power needed to run the model? The other is in the time that it takes to run the model, particularly when you want to plug in your model to an online app, for example, to do auto approvals pretty quickly. You want a model that runs fast, but also in certain specific cases, and I've seen some fancy Monte Carlo models in project finance, for example, which run for a bit of time before they give you a final outcome decision. The actual cost of running multiple Monte Carlo simulations can be expensive. For most retail models, this is not a consideration, and you're likely to go with a simple regression type model. The third area where cost arises is with expert judgments. So for example, I've seen in property finance, assessors rating an area, a geographic location, to say this is a good area or a bad area. This is a growing area with high property inflation or poor property inflation. Those subjective and professional judgments include a process and time and cost of the people who have to provide those inputs. And that must also be considered in the cost of building the model. Once you're happy with the acceptability of the cost of the model, both the cost of building the model, assuming that the model is already built, in the pre-build phase, you might want to consider the costs before you build the model. But once you've passed the cost hurdle, the next thing to think about is, does the model make sense? And that sounds simple, but often it does not in practice. So is the model intuitively appealing? Does the business understand the model, and does the business buy into the drivers in the model? The problem with using a model the business doesn't buy.
I'm going to jump in there for a moment, Pravin.
Sure.
There were 2 points. One is where you're looking at different models, and we were talking about the different data from different sources. One can have a model where you develop it on the internal data and then fix it, and then say, well, we can use this internal data model by itself with none of the other data, and then just kind of paste it on top. But so you've not got necessarily two models. You have kind of model A and then model A plus. And then the other aspect here is you were just mentioning, I'm kind of fumbling here for a moment. Your last point was?
Intuitive appeal.
Intuitive appeal.
With the intuitive appeal, where you have very complex models from the other less transparent techniques, there are ways to try to unpack them, whether you're talking about shapely values or reverse engineering a model. You can take a very opaque model and try to reverse engineer it using logistic or linear regression. It's a little bit tricky, but it can be done.
I think two very important points you make there, Raymond. The first one is where a model is built in phases, like, for example, using the internal data first and then adding on the external data. You have two choices. You can build it as one model, first calibrated with internal data only and then with internal and external data. Or you could build an internal model or a model based on internal data only, and have a separate model or a second step of the model, a two-step model, where the second step then gives you further refinement or further gain by using the external data. The important thing to consider in any event is what's the cost of adding on that internal data versus the extra lift that it gives you. With regard to the complexity and the intuitiveness of the model, does it make business sense? Ray makes a good point that often you can simplify even the output from complex models. The important thing, and what I'm assuming here, is that you're comparing the final version of the model, which is the model that would go in, the version that would go into production, whether it is the first of the full-on complex model, if that is the case, or the simplified version. The important point is, does the model appeal to business? Does it include factors and risk drivers that they believe in? And do they believe the answer that comes out of it, which is the very important point. If business doesn't buy into the model and its risk drivers, what you'll find is lots of model overrides, which then defeats the purpose and the cost of building the model in the first place. It also presents operational and governance challenges, because you could find yourself failing the use test from your regulator, for example, if you're a Basel or similar bank. So very importantly, I think it is the model intuitive to business. The second part of being intuitive is, can you explain it to customers? So if a customer is going to be approved or rejected, can you explain that to your customer? If you take that one step further, if two customers are approved but given a different price, are you happy to explain to those two customers, assuming they're neighbors and coming to your branch together, are you able to explain to them the difference in that rate and the difference in the rate ranking? And that can be quite important in terms of treating customers fairly, or more importantly, being seen to treat them fairly. And then the last part about intuitive appeal is, does it pass governance? Which again, is something that's quite important in any regulated industry. When I say, does it pass governance, is the model going to be acceptable, firstly, to your internal model validation team, secondly, to your external auditors, and thirdly, to your regulator? In certain contexts, you might find one of those three parties being quite conservative. So for example, insisting on a logistic regression model versus a neural net. In other circumstances, you might find them to be very open to advanced techniques. The important thing at the end of the day is, can you satisfy your regulators and your governance path, whatever that governance path is, that the model makes sense, to cut a long story short. Once you're happy that the model is intuitive and makes sense, then there's a couple of other important business considerations. Does the model give you a business benefit? And given that it's statistically, it's already raised statistical requirements, the question is, what can we look at in terms of business value? The first one is the cutoff point. What percentage of customers who come through the scorecard will be accepted or rejected? Does the scorecard give you a good dispersion of customers, so a good spread? Because the better the spread you get from the scorecard, the more likely you are to be able to separate good from bad customers. Different scorecards will rank customers slightly differently. And that's important because within certain segments of the population, you might want to accept more or less risk. And does the scorecard actually offer you the ability to rank correctly in micro segments of your population? So particularly with customers who have been in arrears before, or customers with a poor loan to value ratio, etc. So that's also important. And then the last point, which is quite critical, is, can you easily implement the model? Is it practical to implement? And this is the point that Raymond was making about, you might build a complex model and then you might simplify the output of that model to make it easy to implement. So the first question is, can it be deployed? How long will it take to deploy and to maintain? Once implemented, does it give you answers fast? Again, coming back to, we're moving to a digital world. If it's running on the back of your app or website, does it rank very, very fast? And then the last point, are human resources able to risk manage it and to manage it, period? So what is the human support needed to keep the model in production? And to also run iterations of the model as you update it from time to time. And those are all important. So first we start with, does the model pass statistical rigor? Then we consider its business applications, a number of dimensions we've just touched on. And at that point, I think you're now faced with an ability to start to make a judgment. And maybe Raymond, you want to jump back in here and just sort of bring the two bits together.
Okay. So, okay. Well, at the end of the day, sort of, you do have the 2 bits. And those 2 bits, I'm not talking about 25 cents here. For the American audience, this is something different. So we're trying to compare different models. It might be pre-implementation or post-implementation. And the 2 aspects are the statistical, that stuff that can be measured, and that stuff which is a little bit more difficult to measure and gets into the business realm. That which can be measured, or we hope can be measured, or we're trying to measure, the key ones are the power, complexity, and stability. So is it generalizable? Is it actually going to work in the situation? Is it stable over time? The other ones are overall accuracy when applied to a broad portfolio, whether it's broadly applicable to all cases that fall within the group to which it is being applied, and the fairness. Are there people in there that are perhaps being prejudiced because of something that we don't necessarily know or understand? Some people might think, oh yeah, well, we've got a model. It's sort of like, all's fine and well. Because it's a model, it's got to be fair. Not true. So, but then, as Pravin mentioned, there are a whole bunch of different issues. So on the business side, a big one is going to be the cost element, whether it comes from developing the model, implementing the model, or running the model over time. Something that it came as a surprise to me looking at Data Robot, where it measures how much time it's going to take to provide an answer. You don't necessarily think about that when you're developing the models, but sort of stuff that's kind of downstream that could be very important. The intuitiveness, that really applies to instances where the materiality is high. Pravin, in conversation earlier, mentioned the case. He said, in a lot of institutions, as the portfolios get bigger, they want to apply more complex techniques. A little bit dangerous. One should try to back away from that, but if you want to, just kind of go ahead and do it, but not really wise. But it is that complexity and materiality trade-off. If you're talking about a model used for marketing, if you're talking about models used in collections, sort of in a lot of other areas, those issues are not as great. But when you're talking about the stuff that impacts upon people's lives when you're trying to lend money, you've got to be a lot more circumspect. I think that's really about it. I think as a summary, have I missed something there as a wrap?
I think you've covered it quite well, Raymond. I'm quite happy with that.
Marc? Yeah. From my perspective, we've covered both the statistical and business aspects of this. So, Raymond and Pravin, I wanted to thank you guys both for your time today in discussing how to compare models, because I think this is a very important decision as these companies decide the types of models to implement and the decision factors in helping them make these decisions. I think this is going to be very helpful to many companies and clients out there today. So I'll bring this to a close. To our members out there, we hope you enjoyed another episode of the MRMIA broadcast, especially in this continuing credit scoring series. And we hope to see you tune in next time. Take care.
Thank you. Take care, everyone.
Cheers, everybody. Bye-bye.